Let me go ahead and share my screen. Share. All righty. Can everyone see my screen?
Yes. Yes.
Okay, great. All right. Let me open my chat. Where's my chat? Okay, here we go. Okay, all right. So again, welcome to the first time home buying webinar. And we're going to go ahead and get started. Uh, put this over here. Okay. Again, my name is Abdul Sabir. I'm a mortgage loan originator with MLB Residential Lending. I've been in the industry over 15 years. I work with all kind of buyers, people who buy homes, people who already own their homes and want to refinance or do equity loans, those who want to invest, meaning they want some tenants and be landlords. So I can help you with any kind of product you're looking for. All right. Again, I'm with MLB Residential Lending, and no, it does not stand for Major League Baseball. It's making lives better. All right. Now, this is my contact information, and what I'm going to do, oh, excuse me, I'm going to put it in the chat. And the reason being is I want you guys to reach out to me. All right. So here at the bottom, um, I have my calendar. All right. And you can go here to this link and book an appointment. So go to this link, it's in the chat. You can click on it or copy it and paste it in a web browser of your choice, and you'll reach my calendar. Some of you might be ready to move forward, and you just want a little bit more information via this webinar. You probably did some research. You probably have all your ducks in a row, and you're ready to move forward. So you can book an appointment right away before slots fill up, and we could do a 20-minute one-on-one session and see where you are, answer more questions, and get you started on the road. Some of you may not be ready right away, might need another month or two or so. And we need to sit down and talk and see where you are in your process of home ownership and help you fill in the blanks where you're missing and get you on the way. All right. So go ahead and book your one-on-one session. Everything is free. There's no obligation, but you want to do that before slots fills up. Okay. All righty. So this is my information, and this is my mobile number. You can feel free to call me anytime you have questions as well. All right. Okay. Now, the first question you need to ask yourself is, am I ready to buy a home? All right, that's your first question. Um, and buying a home is different, obviously, than renting. When you rent, you pay your rent to your landlord, and you basically live in that space for however long you maintain that rent, that lease agreement, or a month-to-month situation if you have that kind of arrangement. You never ever own anything. So however long you've been renting, you've been paying your landlord. He or she owns that property. He or she gets the write-off tax benefits for that property, and you don't. And when it's all said and done, and you in your lease, you walk away with just having a space that you rented. Whereas when you buy a house, you own it, you get tax write-offs and benefits in terms of your taxes and your maybe your principal, excuse me, your interest that you write off as well. You gain equity. If you don't know what equity is, let's say you buy a house for $100,000, and then over time, unlike a car or other items that you may have possession of, a house grow in value. Basically, that means over time for in that scenario, a house you buy it at $100,000, maybe several years down the road, it might be worth 110, then 120, then 150, then 200,000. I bought my house, my wife and I, we bought our house in 2016. I think we paid like 352, and right now it's worth close to 700,000. Okay. So what does that mean? That growth in that equity, that's money in the bank. So if I need a loan to start a business, to send my kids to college or go on vacation, I can borrow against that equity. You can't do that with rent. So it makes sense to own a home, especially with today's prices. Rent is almost, in many cases, the same as a mortgage in terms of payment. Now, let's look at the payment. These are the items that consist of your mortgage payment. All right. So when you borrow money to buy a house, unless you're fortunate and you hit the lottery or you have rich families members that got an inheritance coming to you, then you got that cash to buy a house for cash. But the great majority of Americans, we have to go to a bank and borrow money. And so the money that you borrow is called the principal. All right. So that's the principal amount that you borrow. All right. Then you're going to get an interest rate associated with that principal amount that you borrow. And that's the rate that you're going to get. And you probably heard the phrase principal and interest payments. All right. So that's these two items here. Now, wherever you buy, what township you buy in, that township is going to charge you property taxes. Not the lender is going to charge you that, your township. They use this money to pay the teachers, fire departments, etc., parks, works, employees, and things of that nature. Your property taxes, you saw in the movies, I pay your bill when you're talking to a police officer. Well, this is how they get paid from your property taxes, okay? And your township assess that amount to your property that you purchase. Then you have to get in homeowners insurance, just like a car. A dealer is not going to allow you to drive off the lot and uh, get a car without insurance. So a home purchase is the same thing. You have to have homeowners insurance on your property in the event that a hurricane come through, a tree fall on uh, your house catch a fire. Your insurance will cover you and your property and the lender for that matter, so that you can either, based on your policy, fix it or get it rebuilt. All right. Now, depending on your down payment, you're going to get an extra insurance called mortgage insurance. What do we mean by that? Basically, the mortgage insurance, it comes into play when you have less than 20% down on your down payment. All right. So if you put down less than 20% on your down payment, you're going to get mortgage insurance, which is different from this insurance, homeowners insurance. All right. Obviously, the reverse is if you put 20% down or more, then you will not be assessed mortgage insurance. And then depending on what kind of property you buy, such as a condo or a townhouse, you're going to get HOA dues or homeowners association dues. If you buy a property such as a condo or a townhouse, they going to charge you HOA dues because they are going to do all the upkeep around that community. such as if that community have a pool, then they will upkeep the pool, clean it, do whatever necessary to keep it clean, change the water, et cetera, et cetera, et cetera. The common areas, they're going to keep the grounds clean and trimmed, et cetera. Um, if it's a community center within that development, you are allowed to use it for functions and family events and et cetera, et cetera, et cetera. So that's what that is for if you buy that type of property. Okay. Now, these are some other expenses here, such as utilities, cable and Wi-Fi, groceries, cell phone, car, notes if you have a car, and entertainment. Now, the reason we put this here is because, as you'll see on the next slide or two, um, there are some guidelines that we, the lender, have to follow if we want to do a loan and then have it follow the guidelines so that the lender can send it to the second, what is called the secondary market. You probably heard Fannie Mae, Freddie Mac, FHA, HUD, and VA. Okay, so we follow their guidelines. I don't care if it's Bank of America, if it's Chase, if it's your credit union, if it's your local community lender, and of course, our company, MLB, all of us follow their guidelines. And the reason I bring that up is because their guidelines dictate that your mortgage payment that consists of some or all of these things, along with your debt, such as credit cards if you have them, car notes if you have them, and these things here, your credit cards, car notes, whatever appeared on your credit report, all of that cannot exceed a certain percentage of your monthly gross income. And the reason for that is they want to make sure you have enough money left over to pay your utilities, your cable, your groceries, you got to eat, your cell phone, your car note, and everybody obviously wants some entertainment at some time. They want to go on a vacation. So you don't want, if you make $80,000 a year, you don't want your $80,000 going towards your mortgage. You want some of it to pay your mortgage, and you want some of it left, some money left over to pay for these things here. Okay. So all these entities set guidelines to make sure your mortgage and your credit card, car note debts, etc., don't exceed a certain percentage so that you still have monies left over at the end of the month to pay for these items here. Now, how do we determine what you can afford? Well, these are some items here. We need to see, or you need to see, how much you down payment you can get or have already. All right. That's going to help determine how much you can afford in terms of a house. Meaning, when we say how much you can you afford a $200,000 home? Can you afford a $400,000 home? So this is what this is for, to see how much of a home you can afford, how much income you make annually on your job or jobs. If you have multiple jobs, we can take them all, as long as you've been on both jobs a minimum of 2 years or more. Also your savings. The next slide, we'll get more in detail, but we need to see where your closing cost money is coming from. All right. So you obviously you got to pay down payment money and you have to have closing cost money. And of course, we got to look at your credit. All right. Um, what shows up on your credit is going to tell us how you're going to pay back your mortgage loan. Okay. Now let's go to the next one. Okay. Now, at the top of the screen, as you can see, what is needed to get pre-approved. All right. Now, you probably heard that phrase before, pre-approved, and you also probably heard a phrase pre-qualification or pre-qualify. Now, there are two different things. I have pre-approval up here because this is the better one. Pre-qualification or pre-qualify means that you told me you make X amount of dollars a year. You told me verbally that you've been on the job for 2 years. You told me verbally how much you have in the bank for your down payment and closing costs. Okay. So all of this information, you verbally gave me that information. Okay. And then I will issue you a pre-qualification letter, and you take that letter and go to your real estate agent, and he or she will take you out looking for houses that fit your criteria that you want to buy. Pre-approval is better than that because that real estate agent is probably going to be hesitant to take you out. They probably will take you out, but they want to see a pre-approval. So instead of you verbally telling me everything, you back your verbal statement up with documentation. So you're going to give me pay stubs to prove that you do make 80,000 or 50,000 or 100,000, whatever the case may be. And you're going to give me two pay stubs within the last 30 days. So if you come to me today, then count 30 days from a day going backwards in time, and the two pay stubs that you received in these recent 30 days, those are the ones that I want. I don't want December pay stubs. I don't want January pay stubs. I want you to count today, day one, 30 days going back from today, and give me two pay stubs that fit in those 30 days. Okay? Likewise, I want the last 2 years W-2s. And if you don't pay taxes and you get 1099s, then give me the last 2 years of that. All right. So if you filed your taxes already, I know it's not April 15th yet. If you filed your taxes, then that means I want your W-2s or 1099s from 2025 and 2024. If you have not filed your taxes yet, then that means I want your 2024 and your 2023 W-2s or 1099s. All right. I also want your tax returns, your 1040s, not your New Jersey tax returns. All right. Just give me your IRS, the ones that you send to the IRS, which is the first page says 1040, and any schedules that comes with that. Okay. So make sure that you give me the schedule that comes with your 1040s. All right. And again, just like the W-2s, I want the 2025 or the 2024, or if you haven't did your taxes yet, I want 2024 and 2023. If you're receiving child support or you're receiving alimony payments, we can count that as income. All right. I need the documentations as proof. If you got child support, you should have an award letter. And if you have alimony, you should have court documents. Okay. So show me the proof that you are receiving this kind of income, and we can count that as income. And of course, if you're receiving Social Security. So yes, your grandmother or whoever can co-sign with you. Or if you have a sibling or excuse me, a child or whoever that you're collecting Social Security for or from, then yes, you can use that as well. And I didn't put it on here, but the law dictates even if you're on welfare, that's income, and we can accept that by law. Okay, so just a FYI, if you go to a lender and they reject you because they don't want to use your welfare income, then they are discriminating. Okay. All right. Um, Now that's the income section. That's what we're going to determine how much money you make, which going to determine how much of a home you can afford. As we already said on the previous page, we need to see where your down payment money is coming from and your closing cost money is coming from. And it can come from any one of these things. These are entities here, whether it be in your savings, your checking, stocks, bonds, mutual funds, CDs, your retirement plan, a 401k or a pension, you can use that as well. If you got crypto, we can do that as long as you're able to convert that into cash. And down payment assistance for those who might be tight on a little bit of cash for your down payment assistance program. You can take advantage of that. Now, your down payment and closing costs can come from any one of these. or a combination of these. And then also you can use what is called a gift. A gift is you have a family member where I got people coming in, so let me let them in. All right. Um, you have a family member that's willing to help you out with down payment or closing costs. Okay. That is a gift. When they give you that 10,000, 15, 20,000, or whatever the amount it is that they're going to help you out with, we call that a gift. And the reason we call that a gift, because going back to the programs, guidelines to the programs that we mentioned earlier, the guideline says that you're getting this gift with the understanding that you're not going to pay them back, and they know that. Now, what you guys do behind closed doors, we're not going to check. I'll just put it like that. Okay. All right. Then you can also use cash. Okay. Now that's kind of sort of like common sense, right? Well, if you remember when back in 2007 timeframe, the entire world, in particular also America, we had a financial meltdown. That's when there was a loan product called subprime lending out. And it was so easy to get along with that product that a lot of lenders was giving people mortgages who never, ever, ever shouldn't have gotten a mortgage because they couldn't maintain the payments over a long period of time. So as a result, all those people who got those mortgages start foreclosing. They basically mean they stopped making their payments because they couldn't afford the payments. And as a result, um, the whole world felt the effect of that. And so laws were put in place to prevent that again. And as a result, some laws that resulted from that financial meltdown says that if you are using cash, we, the lender, I don't care if it's Bank of America, I don't care if it's your credit union, I don't care who it is. We have to check to make sure that your cash didn't come from drug money or terrorist money. So, how do we do that? Well, there's something in our industry that is called seasoning. And seasoning means that that money has been sitting in the bank for a long enough time that we're not going to question it. Okay. So basically, that money needs to sit in your bank account, whatever account it is, savings or checking, don't matter, for at least 2 months or more. So if you got money in your mattress right now and you put it in the bank right now, and then tomorrow or next month, you come to me for a loan, I'm going to say I can't use that money because it has not been in your account long enough. So you got to prove where you got it from. And that's probably going to be difficult because it's cash. And you probably don't have a receipt of where you got that money from, right? Okay. So obviously, how do you get around that? You put the money in the bank, and 2 months from now, you come to me for a loan. And then your bank statements will show that that money is seasoned. All right. So that's how that works. Okay. And then we're going to look at your credit report. That's a given. Your credit report is going to tell us how you've been paying your current and past bills, which will be a strong indicator of how you're going to pay us when you get this new mortgage. All right. So obviously we want to see if you've been paying your bills on time. Whatever shows up on your credit report, we want to see if you've been paying them on time. Now, if you have or had any late payments, that's not a deal breaker. If you had it, then that means you caught up and you're back on time again. If you currently have any late payments, you want to catch up. All right. So obviously that's going to affect your credit score, and your score is probably down as a result of that. Collections. This one is a deal breaker here. Collection accounts. So if you got any charge accounts, medical bills, or what have you, that's currently in collection, then you want to catch up and get that current. All right. Um, you can get approved if all your other items are in place, meaning you do have the income, you do have the down payment and closing cost money, etc. Your credit score is still high enough to get approved, but you still got these collections. You can get approved, but however, you will not close on a loan if you don't pay those collection accounts off. All right. So you have to pay those off and then you'll get approved. You'll be able to close at closing. Okay. Foreclosures. You won't be able um, to get a loan if you have a foreclosure right away. Basically, what you have to do is you got to wait. I believe it is 7 years to before you get you can get approved for a loan. If you have judgments, it's a case by case situation. You may have to pay judgments off, or you might be able to get by. The underwriter will let us know in that scenario. All right. Also, bankruptcies. There's two kinds of bankruptcies. There's a Chapter 7, and then there is a Chapter 13. A Chapter 7, you got to wait a couple of years before you can get approved for a loan. And a Chapter 13 is where you arrange where you make monthly payments to pay off your debt, okay, to the bankruptcy court. In that scenario, you got to wait 1 year before you can get approved for a loan. And also, that first year that you're making these payments to the bankruptcy court, each payment has to be on time. You cannot be late. If you're late, then you probably won't get approved for a loan. And you may have to wait another year and make on time payments for a year before you get approved for a loan. And then, of course, rent. If you obviously are renting, we want to make sure you've been paying your landlord on time. And much of this information we get from the credit bureaus, Experian, Equifax, and TransUnion. Okay. Now, I recommend everybody go to Credit Karma if you don't have an account with one of these bureaus and pull your report and see what it looks like. You're going to get Equifax and TransUnion. You won't be able to get Experian from Credit Karma. Credit Karma is free and it's no hits on your credit reports. Okay. You just want to get an idea where you are. Okay. Now, just be advised that that is a consumer report. Even if you're going directly to Experian or Equifax or TransUnion and you have an account with them, that's still a consumer report. Every lender gets what is called a full factual that's not available to the consumer. All right. So basically, what I'm saying to you, that consumer report, your scores might be looking real good there, but when a lender get a full factual, your score might be slightly lower. Now, in some cases, it might be the same. We won't know until we pull it. But just know, I like to say a consumer report is like a Honda Accord. A full factual is like a Mercedes Benz or a Rolls Royce. So there is a difference there, okay? Alrighty, moving forward. Now, these are the programs that I mentioned earlier. So what kind of loan program are you available for? All right. So when you come to me, I'm just not going to give you one program, one size fit all. I'm going to look at your situation and I'm going to at least give you a couple of options and let you pick and choose which program you want. All right. So you probably heard the phrase before, conventional loan and government loans. And under conventional, we have Fannie Mae and Freddie Mac. All right. Now, with these programs, they dictate the guidelines as we already mentioned. And basically, if you want to take advantage of their low down payment programs, you have to obviously fit their guidelines and requirements. So Fannie Mae says if you want to put down their absolute minimum amount, which is 3% down, then your credit score has to be a minimum of 680. Okay. Now, you know there's three credit bureaus from the previous slide we just looked at. We want the middle score. That's the one that we're going to judge you on. Okay, what is the middle score? The out of the three, one of them is going to be low, one of them is going to be high, and the other one is going to be in the middle. That's the one we're going to judge you on. Every lender, I don't care where you go. They're going to, and you probably heard the phrase FICO. So FICO is basically the one that's in the middle, not the lowest, not the highest, but the one in the middle. Okay. So this is Fannie Mae guideline. So if you fit this criteria, then you can get a 3% down program. Of course, you don't have to put 3% down. You could put more than that down, but this is the absolute lowest. Freddie Mac says if you want to put down 5%, which is their lowest, then your credit score has to be a minimum of 620. All right. Now, as we mentioned on the previous page, if you don't put 20% down or more, then you're going to get this insurance here tacked onto your mortgage. Okay. All right, so now that is conventional loans. Now government, everybody heard of HUD. Well, HUD have a couple of products, FHA and VA. All right. So FHA requirement is if you want to take advantage of their 3% down program, you have to have a minimum credit score of 580. All right. And if your score is lower than that, the absolute lowest FHA will go is 500, but you got to put a minimum down of 10%. All right. And those who have served in the military, you can get a VA loan if you are eligible, meaning you was what's the phrase go? uh Basically you're in the military now, or you left the military in good standing. The phrase escapes me right now, but you should have a certificate of eligibility uh when if you left in good standing or still in the military. And if you have that certificate of eligibility, we need that, and you can take advantage of their product where you could put zero down, and that means they'll give you 100% of the sales price. But your credit score, the minimum is 620. All right. And obviously, there's going to be mortgage insurance, and VA has what is called a funding fee. That's going to be assessed at closing. Okay. Now, then there's what is called terms, meaning the rate and term. As we mentioned before, you're going to have an interest rate associated with your mortgage that you get, and the term, the amount of years you want to hold this mortgage. Okay. Now, with the rates, you have the option of choosing a fixed rate or an adjustable rate. The difference is probably obvious to you, but if you never heard these terms before, a fixed rate means that whatever rate you choose, and I'm going, like I say, I always give my customer options. I'm going to look at the rates when you're ready and see what the rates are that day, because rates change every day except for weekends and holidays. So when I say change, they go up and down. And you've probably been watching the news, and because of this recent war taking place, it has affected the rates, and the rates have gone up a little bit. All right. But bottom line, I'm going to give you the best selection of rates that's available, and I'm going to let you pick and choose which one you want. Okay. Whichever one you pick, it will stay the same. So that if you remember the previous slide, principal and interest payments, well, that's this part here. It will stay the same forever for as long as you hold that loan. Okay. It will never change. There's sometimes lenders sell your loan. So the lender that you start out with, whether it be Bank of America, whether it be my company or whoever, sometimes they sell the loan to a servicing company. And a servicing company, all it is a company that collect the payments for Bank of America or for our company or whatever the case may be, and send your taxes to your township and send the insurance payment to your insurance company, whether you use State Farm, Allstate, whoever you pick and choose to use. Okay. The point being is, even if your loan is sent to a servicing company and you chose a fixed rate, this could never change. It's against the law for another lender to change your rate. Okay, if you chose a fixed rate. Now, however, if you pick a adjustable rate, then obviously it's in the name. The rate is going to adjust. All right. These rates are typically lower than fixed rates programs, but because they adjust. Now there's something that called caps, annual caps and lifetime caps. I don't want to get into the detail of that, but basically these caps are put in place to make sure they don't go too high. Okay. But bottom line, there are 1 year adjustables, there are 3 year adjustables, 5 years, and 7 years adjustables. So if you get a 1 year adjustable, then that means your rate is going to change once every year. If you get a 5 year adjustable, then that means your rate is going to stay the same for the first 5 years. And then the 6 year and going forward is going to adjust once every year. All right. So basically, in a nutshell, that's how those typical programs work for adjustable rate. Now, whether you get an adjustable rate in the beginning or a fixed rate, you can do what is called a rate lock. You can lock your rate. What is that? Um, Somebody's joining us. Give me a second. Uh, okay, so basically, a rate lock is whatever rate you pick in the beginning, then we will lock that rate when you're ready so that that rate will be there by the time you close on your home. Okay. Why would you want to lock your rate? Because we said the rates change, go up and down. When we say change, the rates go up and down every day except for weekends and holidays. Okay. So what that means to you is you come to me. I go through everything. I look at your pay stubs, your W-2s, your income and your savings and all of that. I pull your credit and boom, we do an application. I issue you a pre-approval letter. You take that pre-approval letter that shows that you can afford whatever, a $400,000 home. You take that to your real estate agent and your real estate agent get criteria from you. You tell that agent, yeah, I want a pool, I don't want a pool. I want 3 bedrooms, 2 bath, I want 3 bedrooms and 1 bath, whatever the case may be. You give your criteria to the real estate agent. You tell them what towns you're interested in living in. He will take you to houses in that area. That whole process of taking you to different towns and different houses in those towns is going to take you probably 2, 3 months or more before you find that very house that you like and you want to buy. All right. Probably one in a million is going to pick the house the first go when they get out there looking for a home. Everybody else is going to take you time to find the right house that you're going to be happy with. It's all right. Something is always going to not be to your liking, and you're going to say, no, not this one. Also, what's going to happen is you're going to get outbid. You're going to find a house that you like quickly, but somebody's going to outbid you and pay more money than you're willing to pay. All right. So these kinds of things happen. And so therefore, on average, it's going to take you 2, 3 months, give or take, more or less, for you to find that right house and you submit your offer and the seller accepts your offer and you close. So that means during that time, the interest rate is still going up and down. And so by the time you're ready to close and lock that rate in, it might be high. So you want to catch it while it's low and tell me to lock the rate in while you're doing your searching those couple of months. And I lock it and I give you a 45-day lock or a 60-day lock, which will give you enough time to do your home searching and find the house that you like. And so when you find that house and you sign that contract and we do the appraisal and do the title work, we do all that before that lock expires. If that lock expires, then you go back to the market and whatever is available at that day, then that's the rate you got to start with. Okay. So locking a rate is very important. Now, again, the term. The term means you get a 10-year mortgage or a mortgage that lasts for 15 years, or a 20-year mortgage, or a 30-year mortgage. And there are 40-year mortgages, but in all of my years, I never did a 40-year mortgage. I can't remember. Maybe I did one. I don't know. But most people get 30-year mortgage. Some people make, very few people that I came across get lower than 30-year mortgage, but you can choose that if you want. Now, what's the difference? It's just like a car note. Some of us bought cars and we stretched the payment out, the term out so that our payment will be lower. So basically, the longer the term, the lower your monthly payment. The shorter the term, the higher your monthly payment will be. That's the difference. That's all that the difference is. Now, incidentally, also, no matter what term you get, you can pay your mortgage off quicker. So most people get a 30-year mortgage. You could turn your 30-year mortgage into a 20-year or a 15-year or a 10-year. That depends on how aggressive you are. And how do you do that? Just like rent, you make your mortgage payments every month for 12 months in each year. And then if you got some extra cash, typically around tax season, that extra cash, whatever you got that you're willing to put forward, you can pay on your mortgage and put it towards the principal balance only. So if you got $1 extra, if you got $100, or if you got a mortgage payment worth of money, then put it towards your principal balance only, and that would chop off your mortgage if you're consistent on and on and on, and you can get it down. You can pay your home off in 20 years, but you're making a 30-year mortgage payment, if you will, if you understand that. So if you need more details on that, doing your one-on-one session with me, your 20 minutes free session, we can go in details with that. Okay. Now, for those who are buying in rural areas, USDA product is good for you. Okay. And then we have what is called non-QM loans. So that means these are QM, qualified mortgage. That's what that stands for. Non-QM means these are non-qualified mortgages. And what is that? Remember we said earlier, back in 2007, 8, we had a financial crisis, a meltdown. Okay. Um, those products will fit under non-QM loans that caused that financial crash. Those products were still legal back then, but again, lenders misused it and buyers misused it. They exploited it and caused the financial crash. But they're still legal and still good. The subprime, they discontinued. But basically, the debt to income ratio is higher than Fannie Mae, Freddie Mac, and HUD and VA. And so that means, remember we said earlier, they want a certain percentage of your income to be available so that you could pay for groceries, entertainment, car notes, et cetera, et cetera, et cetera. Well, that ratio is higher so that you can qualify for a non-QM loan and your credit score requirements can be a little bit lenient, at least compared to conventional. Okay. Now, under these programs, if you don't fit in this category here, then we'll look in this category to get you approved. The only difference, the only major difference is the interest rate is probably higher than these guys here, the interest rate that you'll get in these categories. All right. Okay. So moving forward, now we're going to look at the down payment assistance program. All right. Now, New Jersey has a program, which is what you're looking at now. All right. And they have two, which you can use both of them. They have a first generation program where if you qualify, you can get up to $7,000 in down payment money. Okay. In addition to the down payment assistance program, you'll get with this combined with the seven and this, you'll get up to $22,000. All right. And these are the requirements down, some of the requirements down here. So let's take a look at uh, what does this mean? All right. So now, um, I don't know if you can see this, but it goes by county. So if you live in one of these counties, the down payment assistance program, this is like automatic. If you qualify, you'll get 15,000. And then if you qualify for the first generation, you can get an additional 7,000 for a total of 22,000. If you live in any of, I should say live, I meant to say purchase. If the house that you want to purchase is going to be in one of these counties, then you can get uh, up to 22,000. If the house that you're going to purchase is going to be in one of these counties, then the down payment assistance, you can get 10,000. And if the first generation, you can get additional 7,000 for a total of 17,000. So what is the first generation? The first generation program, and somebody else is, let me let him or her in. Um, the first generational program is basically, you're probably reading it down here in the previous page, meaning if your parents currently do not own a home and you are the first person in the generation to purchase a home, then that's how you get this additional $7,000. Now, for those who are from the Caribbean islands or anywhere else for that matter, New Jersey will check to see if your parents own a home outside of this country. All right. So they will check. Africa, I don't care where you're from, Asia, wherever, they will check. Okay. So basically you got to be first generation. Now, you probably be reading as well. Um, Also, if they own a home and they sell it, then you also can qualify for the first generation. But what parent is going to give up their home, right? So if you're not able to get this $7,000, at least you can qualify for either the 15 or the $10,000. Okay. All right. So that's how that works. Now I have to let you know, I have never did one of these loans with the state of New Jersey, because they are a little strict. But we can put the application in. You cannot go to them directly. Um, you have to go through a lender like our company that is approved by the state of New Jersey to provide their product to the public. Okay. So our company has been approved by the state of New Jersey. And then furthermore, each loan officer, meaning I, had to go through their training and get certified to offer this product. So if a company is approved by the state of New Jersey, but the loan officer has not got certified, then that company cannot offer this product. Okay, so we're fully approved and I am certified to offer this product. Okay, so in the event that you don't get approved by the state of New Jersey, I have a colleague who uh, submitted a loan to them, and his credit score was there and everything, but New Jersey didn't approve it. So He was the guinea pig, so I didn't submit my customers. But they do approve loans. We just got to try and see if you want to go that route. But in the event that they don't, this is our program. We have our own down payment assistance program. Okay. All right. So basically, similar to New Jersey, you have to have a minimum credit score of 620. All right. You got to put 3.5% down because that's the FHA requirement. All right. And it has to be an FHA loan. And you can use this to buy a one-family home or a two-family home. And of course, one of them, if you're doing a two-family home, you got to live in that one of those units. It has to be your primary residence. Okay. All right. Also, um, non-owner occupant co-borrow is allowed. What does that mean to you? I just did a loan last month, February, where a mother and a son bought a property, and it was an FHA loan, but we didn't go through obviously New Jersey, as I alluded to. I never submitted a loan through them. Um, and his mother already owned her own property, her and her husband, but his income was slightly lower. So she co-signed. Obviously, we use her income with his income to get him approved for the house that he wanted to buy. So because she already owned her own home and she's not willing to move into her son's property, the guidelines dictate non-owner occupied co-borrowers are allowed. So we got the loan approved and we closed and he moved in his house. Okay. So that's what that means. All right. Now, basically, as it says here, we'll give you 2% of the sales price, down payment money for free. And here is an example. You find a house, the sales price is 400,000. 2% of that is 8,000. So we will give you $8,000 free money, okay, that you don't have to pay back. Now, these two programs, ours and the state of New Jersey, are not the only one out there. There are others, but you have to check the guidelines. Some of them will require you to stay in the house for 5 or more years. And if you leave the house, meaning you refinance or sell the house, then you have to pay that money back. All right. So some programs is not free money where you get approved for a down payment, but it's actuality, it's a loan. And the monthly payment, whatever it comes out to be, $100, give or take, they include that into your regular mortgage payment. And so you're paying back your mortgage and your down payment money or closing costs that you got from them. So you have to, if you going for other programs out there, you got to check out the guidelines and requirements and stipulations so you'll know what you're getting into. All right. Next, the do's and the don'ts. Now, you want to pay attention to this part here and make sure you don't fall victims to the items that's on this page here. Do not change jobs after you do a loan application for a mortgage. Okay. This happened to me. A friend of mine years ago, father wanted to get a mortgage. And in the process, he kept telling me he hated his job. He hated his job. And so while we were processing his loan, after he got approved, he quit his job. He thought he had it made, meaning we approved the loan, but we still were processing the loan. All right. We still had to do title and things of that nature. So basically we didn't close yet. So we found out that he quit his job. So what does that mean? He don't make enough money to pay for the mortgage. So therefore we declined his loan. So what does that mean to you? Every lender is going to check your credit in the beginning. And if your credit is good, then we'll approve the loan if everything else is good. And guess what? Every lender is going to check your credit at right before closing to see if anything new has happened. Every lender is also going to check your employment, just like my friend's father. Okay. So don't try to get slick after you get approved. When you got to wait until you close before you make any changes, if you tend to make any changes. So don't change. Every lender, based on those guidelines we alluded to, we need to see that you've been on your job for 2 years or more. Okay. If you change jobs, the only way it will work for you is if this happens. And this is just an example. Let's just say I like to use nurses for example. Let's say you're a nurse and you work for one hospital. You change jobs while we're processing your loan, or you changed jobs recently before you did the loan application. Bottom line, you don't have 2 year history on this new job. And this new job that you changed to is another hospital. So therefore you get in the same position as a nurse. But who knows, you might be making more money. But basically what we look at as lender is you're in the same category in terms of your job title, same kind of work, and you're in the same income bracket. Nurses get paid this much. Uh, Construction workers usually get paid this much. Computer analysts get paid this much based on the industry. So basically, what I'm saying is you changed job, but you didn't change industry. And so in that scenario, we can take the income that you are getting from the new job, even if you only be on that job for 1 month. But if you change job and you're a nurse and you quit that job and you start a new job and you're a teacher, that's not going to work. We're going to decline the loan. You got to wait 2 years to establish a work history in that new industry as a teacher. All right. So do not change jobs while we're processing your application. All right. Don't buy a car. Do not use your credit cards excessively. Pay your bills on time, including student loan. Now that same mother and son that I just mentioned that we close on, he got a deferment on his student loan. He thought it was for 6 months and it was only for 3 months. And so therefore, 3 months, he was late on his student loan. Fortunately, he caught up on his student loan and his score took a hit, but fortunately, it was still high enough for us to get him approved. So pay all your bills on time. Like I say, we're going to check your credit in the beginning and we're going to check your credit at the end, right before you close. Okay? To see if you bought new furniture for your new house, you bought a car. You don't want to do that. You don't want to mess yourself up because we will decline the loan. All right. Um, Also, large deposit. Remember we spoke about cash? Okay, so this is the same thing. Now, you're going to get money that obviously is legal and legit. So if you do make large deposits, then all you got to do is show us the paper trail. So in that same scenario, let's just go back to that previous scenario where your parents is giving you a gift. Okay. Give me 1 second. Somebody's joining us. Okay. Um, your parents is giving you money to help you out with your down payment or closing costs. We need to see a paper trail. So what that means is we need to see their bank statement to show where, let's say they're giving you 10,000. We need to see where that $10,000 is coming from. Okay. So we need a bank statement. Then we need to see this statement where when the time comes, they give you the money. We need to see a statement where it was withdrawn from that account. And then we need to see your bank statements to see that that money was deposited into your account. All right. Otherwise, we can't use that money if you don't provide those statements. Um, Also, do not change banks. Um, It'll make it easier for us. When the bank statements that you give me in the beginning, keep your money there and don't move it. If you move it, then we got to create a paper trail. Where did this money come from? Where did it go? I need to see withdrawals and I need to see deposits. So I need those bank statements. So don't move your money until it's time to close on the loan. It makes things a lot easier. Also, do not co-sign for anybody while we're processing your loan. All right. It's going to show up on your credit report, and then that's going to affect your debt to income ratios. All right. And then this is a good one. We are going to, it's common in this industry for lenders to ask you for documents and ask you for a lot of documents, and sometimes ask you for the same documents. All right. It's common. It happens. So don't get frustrated. Here's a scenario why it would happen. In that same scenario we just said, you come to me, we do the application today. I check your credit, income, blah, 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 issue you the pre-approval letter. You take that pre-approval letter to your real estate agent. You guys go house hunting. It's going to take you 3 months on average to find the house that you like, yeah, and for your offer to get accepted by the seller. In that 3 month period, your bank statements and your pay stubs that you gave to me 3 months ago has expired. Because remember, we said we need 30 days of pay stubs. Well, 3 months have passed. So that those pay stubs are no more good. Now we need fresh new pay stubs. So now that you found this house 3 months later, we're going to need updated pay stubs and probably one more bank statements, 1 or 2 more bank statements, depending on how many months go by. So that's a legitimate scenario of why we're going to ask you for the same documents over again. So don't get frustrated. Just the faster you provide it, the faster we can make it happen for you. Okay. All righty. And then what else is required? Now, I've been hinting on some other things that's part of this process. All right. So I'm a loan officer. I'm the first stop that you should make in your journey of buying a home. You want to secure the money. All right. No real estate agent, as we said before in the earlier part of this session, no real estate agent want to take you out looking for homes if they don't know you have been pre-approved. So I'm your first stop. Make sure you got the money. Make sure you're approved. Then in the process of processing your loan application and you find that house and you sign a sales contract, we're going to order an appraisal. Okay. Appraisal is obviously we're going to appraise the property that you are looking to buy to make sure that it is worth the amount that the seller is selling it for. Let's keep it simple. Let's say the seller is selling it for 100,000 and we do the appraisal and it only comes out to be worth 90,000. The lender is not going to give you $100,000 and the house is only worth 90,000. So in that scenario, you got two options. You can renegotiate, and I'm gonna give you a copy of the appraisal so that you can take it to the seller. You won't be able to talk to the seller directly. You let your real estate agent know this is the appraised value, and your agent is going to call me anyway, so he or she might find out before you, unless I'll call you anyway, regardless. But anyway, and your real estate agent will let the seller know the agent for the seller know that, look, the house is only, and I'm using simple numbers to make sure it's understandable. We know houses are worth more than 100,000. So they will let the seller know the house is only worth 90, so you need to come down by 10,000. All right. Somebody needs to go on mute. We hear some background noise.
Yeah, can you mute, please? Yes.
Let me mute some people here. Okay.
Yes.
All right. Okay. All right. So in that scenario, you can renegotiate and have the seller reduce his or her price down to the value of the appraised amount. All right. Or your other option is um, if you probably heard the terms buyers markets and seller markets, depending on the market is in, meaning if it's a lot of inventory, then of houses out there, then the seller might be willing to renegotiate. If the inventory out there is low, then the advantage sits on the seller side, and he or she may not be willing to budge. And so that's when a bidding war come into play. You might not be the only person looking at the house, and somebody might be willing to pay that $100,000. And in some cases, as we said earlier, 105, 110, they may bid it up. And this is why sometimes um, it takes you 2 or 3 months to find the house that you want because of different scenarios that may take place. Okay. So bottom line, appraisal is needed. And then a title report. Okay. So now the title report is like a receipt to your house, in addition to what is called a deed. Okay. What is a title report? It's to verify that the owner does own the property that you're buying the house from. Okay. Also, liens may show up on that title report. Judgments may show up on that title report, whether the judgments be from the seller or your judgments, because a title report, the title company is going to the courthouse and looking for records, judgments, and everything. And so your judgments, if you have any, may show up. And therefore, depending on the program and the underwriter, uh, you may have to pay those judgments off if you do have some, or depending again on the program, et cetera, you may not have to pay them off. But the seller will have to pay his stuff off because you want what is called a clean title. Now, let's just say, for example, you're buying the house from me. And let's just say 5 years ago, I had some work done on my house, my roof, my whatever, electrical system. Let's just say I had some work done and the contractor finished most of the work, but I didn't like, let's say he finished all the work. And let's say a certain part of it, I didn't like the workmanship and the quality. And so the last installment payment, I didn't pay that contractor. And let's say that the amount I owe him is $5,000. Fast forward 5 years, now you want to buy my house, but you don't know until the title report come out that that contractor put a $5,000 lien on my property that you want to buy from me. Well, you're safe because your attorney did a title report, and the lender, we, going to demand a title report. Okay. And my 5,000 lien on my property that you want to buy is going to show up on the title report. And I'm going to be forced to pay that $5,000 lien if I want to sell my house. And that 5,000 is going to come from the proceeds from what you use to buy the house. Okay. So that's how that works. You need a title report. No lender is not going to let you close without it. Okay. Now, depending on where you live, North Jersey is common to use an attorney to represent you at closing, and South Jersey is common to use a title company. So you pick and choose who you want to represent you at closing. If you need someone to hold your hand, to read your contracts, and help you understand the legal jargon in those contracts, then I would say, and also to help you negotiate as well, I would say go with an attorney. Obviously, he or she's going to have attorney fees, and you pay those fees at closing, which is going to be obviously part of what is called your closing costs. If you uh, okay without using an attorney, you fairly know how to read documents, or you just don't want to pay the attorney fee and save money, then you can use a title company. The state of New Jersey does not require you to use an attorney to represent you in a real estate transaction. So you're free to use an attorney or a title company. If you use an attorney, obviously he or she will use his or her favorite title company to do the title work. Okay. If you want to bypass the attorney fee and save yourself some money, then you can just go straight to a title company and have them pull title and have them conduct the closing. And I can help you out with title companies if that's the route that you want to go. All right. But both, whichever direction you go, those fees are paid at closing. Okay. You have to get, as we've been saying throughout the session, you have to get homeowners insurance. So therefore, you got to pick the company that you want to go with. And looks like somebody is joining us a little bit late in the process, but they can come in. Um, okay, so you have to get homeowners insurance, just like a car. You're not going to be able to drive off the lot without insurance. You go to whoever you want. When I wife and I, we bought our car, excuse me, our house. We already was using Geico for our car insurance. So we went to Geico for our homeowners insurance for our house. So you're free to use whoever you want. Definitely you want to get quotes and they'll give you a quote and let you know what it's going to cost you to insure the property that you're intending to buy. Then also, as we've been saying throughout the process, a real estate agent. You got to work with a real estate agent if you want to get inside the house that you are looking at. Okay. Now, there are two type of agents out there. There's a buyer's agent and a seller's agent. And they could be two different people or they can be one and the same person. If it's one and the same person, then that means you found an agent that will work with you to help you find a house. And the house that you found is the same house that that agent listed and put it on the MLS, the multiple listing service. Every real estate agent has access to what is called the multiple listing service, MLS for short. And this is where real estate agents will come to you, let's say, whatever, 10, 20 years later, when you're ready to sell your house, that you sign some documents, and then they will put your house up for sale on the multiple list so the world can see that your house is for sale. All right. Now, if you go to find an agent that has not listed that property, then that's going to be a buyer's agent, meaning they're representing you. Now, just be keep in mind, it's not a bad thing. It's just FYI. A agent that lists the property is working for the seller, the owner of the property. They're going to be working for you as well, of course. And by law, they have to, be above board with everything. But know that they list the property, and so they, have the seller has influence over that agent. All right. Okay. So now let's look at costs. Um, the real estate agent, you're going to be more than likely paying the buyer's agent his or her fee at closing. All of these different fees is comes up in what we call the closing costs, as it states here, closing costs, and this is paid at the closing table. Okay. If you get an attorney, his or her fees will obviously be at the closing, included in the closing costs. And also the title fees, as we mentioned. Escrows is nothing more than your taxes and your insurance, and every lender will collect um, at closing maybe 2 months worth of taxes and insurance, so they know that they have that money's ready. So when it's time to send the money to your township and your insurance company, that money is there for them. And then when you make your mortgage payment every month, the escrow account replenishes with your tax payments and the insurance payment. And then there's loan fees like a commitment fee, origination fee, etc. Okay. All of these are part of the closing costs. Now, between all and there's an appraisal fee and a credit report fee as well. Okay, and then at the bottom there's a home inspection and then a termite inspection. Now, everything from here on up, you got to pay for it. You can't get around it. Whether it's some of these fees are upfront, meaning before closing, and some of these fees are at closing.
Yeah,
These,
I'm listening to something.
okay. All right, please go on mute and we can open it up for question at the end. Now, these fees at the bottom, these are optional. You don't have to get a home inspection and you don't have to get a termite inspection. We as lenders, we don't require these. I can tell you right now, this is probably one of the most important ones of all these fees. Now, all of them, all these services are very important, but these are not required to get and pay for, but are very important. Let me share you a story. Earlier in my career, I wanted to be a landlord, and so I bought a house. And I bought the house from the brother of my best friend. Okay. So now, mind you, what I'm teaching you, I already knew because I was still in the industry at the time. Okay. But because of the relationship, I didn't obey what I'm teaching you because I did this transaction on trust. Because again, he's the brother of my best friend. If anybody ever seen the movie with Tom Hanks called Money Pit, that was this property. This property had every problem you could think of. And so obviously, when I bought the house, I was constantly fixing repairs, fix and repair. And so as a result, I'm telling you guys, you want to get a home inspection because it's worth it. All right. And you can use the report that the home inspector provides you to renegotiate with the seller. You can whatever, let's just say the home inspector do the home inspection. They're going to go in this property and they're going to look at everything and whatever is wrong, they're going to put it in the report. All right. And they're going to go over the report with you and let you know the roof is only good for another 2 years or 20 years. Roofs normally last for 20 years. He or she will most likely it's a he will go over the report with you and let you know the lifespan of each item, what needs to be repaired right away, what you can probably wait for, etc. Whatever the situation is, he'll go over it with you. And if something needs to be fixed, and he will give you some estimates or idea what it's going to cost, and you can go back to the seller and renegotiate. That's a renegotiation tool. And tell the seller, look, you got to come down on your price based on this amount of repairs I need to do to your house. Or seller, give me a credit, meaning if it's going to take 15,000 to fix this, then give me a $15,000 credit at closing, and then I'll do the work myself. So you have those options, and your attorney and or real estate agent can help you with that to renegotiate if that comes up. Okay. All right. So now we're talking about fees. These fees will be paid at closing, as well as your real estate agent fee. Your just like a car, you got to shop for your homeowner's insurance and pay for your insurance premium to get a policy before you close. So obviously, you got to pay for this before you close. Your appraisal, we're going to order this, so therefore you got to pay this upfront fee. So therefore, when we order the appraisal, uh, the company, the centralized appraisal company is going to find licensed appraisers in the area of the house that you want to buy. Whoever accepts the job, That appraiser is going to call you and let you know that they're going to be reaching out to the real estate agent to get inside the property to appraise it. And they're going to be asking you for payment. So you need to have your credit card ready. Okay. Also, you're going to, like I said, you'll be paying for your insurance. And then again, soon as you get a sales contract signed on the property, you want to get a home inspection. Now, and so uh, this one, this one, and this one, you got to pay up front, and also your credit report fee. Everything else you pay at closing. Now, let me mention this to you. For the home inspection, you want to play home inspector yourself because the average person is going to probably look at 10, 15, 20 houses before they find the right one and the right one get accepted. So you don't want to pay a home inspection fee for 10 or 15 homes because the average home inspection fee costs probably $500. All right. So you want to play home inspector and go inside each property and look for problems yourself. And obviously, your untrained eye, if you see something, then that'll tell you, no, I don't need to pay $500 just to tell me something I already know. All right. So you got to play home inspector, do it yourself. And then if you find the property that you like and your untrained eye can't find any problems, then that's your cue to get a professional in there and home inspect that property. All right. Okay. So moving forward, that's pretty much it. Now, as we mentioned in the beginning of the session, my contact information is in the chat. You want to book your one-on-one session, free consultation, 20 minutes. Go to this link here, and it's in the chat, and book your appointment. All right. They fill up fast sometimes. So you want to try to get the best time slot that's good for your schedule. This is our website, my mobile number. You can call me at any time as well. Now, let's open up for Q&A. You can um, either unmute and ask a question, or you can put your questions in the chat as well. E- Either or. Does anyone have any questions?
Hi, how are you? Good evening.
Good evening.
I just have a few questions actually. You said about the scores.
Yes.
Um, okay, so on the FICO app,
Hmm.
they have your FICO score, and then they have other sections that says for mortgage and loans and stuff. So is it safe to say that you guys use the numbers from the mortgage? Because if you go to their app, it opens up and then it tells you your overall numbers in general. And then if you go to they have specific sections where if you click on it, it will show you numbers for what your mortgage rate is and what your car loan rate is and all that stuff.
Oh, you're talking about a mortgage calculator? Is
No,
that?
the FICO app, because you said the
Oh,
FICO
FICO.
score, and
Oh,
there's a
FICO
fight
app. Okay. Okay.
right on the FICO app.
Okay.
Because you get your scores from Experian
Hmm.
and Equifax and Transfusion is always very high and
Okay.
nice and
Yeah.
pretty. And then you have Equifax and Experian that tends to be lower. Um, but the
Okay.
FICO app takes all those in consideration since the FICO score is what you guys use. And
Yes.
there's two sections in there, one for mortgage rates and one for car loans. So my question
Okay.
is, do you use the mortgage rate ones, obviously, to give us a score for a credit score for the loan application?
Okay. So, if I understand your question correctly, we don't give you the score. Um, the score comes from the three credit bureaus.
Right.
Okay, so Experian, Equifax, and TransUnion, they create your score, and
Right.
they create that score based on your payments.
Right.
You've been paying the mortgage, and excuse me, or your debt, whether it be your car loan, student loan, credit cards, and if you have a mortgage as well. And
Right.
so if you pay on time, you're going to get a good score. If you abuse your credit, meaning you pay on time, but you max out your credit cards, etc., that's going to make your score dip a little bit. Okay.
So you
So
don't use the FICO scores,
we do
or
use them. So what we do, every lender, we we obviously, I don't know if you was at the beginning, but we pull what is called a full factual. So every lender, when they pull your credit, we pull a full factual, which is basically what I'm saying to you. You
uh
can't get a full factual because you're a consumer. So no matter where you go, FICO, or if you go directly to TransUnion or directly to Experian and pull your report, you still going to get a consumer report. But when a lender go to TransUnion, Equifax, et cetera, we're going to get a full factual. We pay more money for the report. And so I compare it like this. Your credit report you pull that you get from Credit Karma or FICO or TransUnion, Equifax, that's a consumer report, and that's on the level of a Honda Accord. When we, the lenders, pull your report, the report we get is on the level of a Mercedes Benz. So that's why sometimes the consumer report might be inflated a little bit, and you think you're real good, and then when we pull it, your scores might be slightly lower. And then in some case, I've seen it where it's the exact same as the consumer report. So we don't know until we pull it. All right.
Well, that shouldn't be good, because then that makes us feel that we can't trust a lender, because we think you're lying to us because you want to make your commission. You know what I
No,
mean?
no,
You know what
we
I
don't.
mean? Because
I
if
understand what you're saying.
because they're not saying FICO and all them, they're not telling us that. You know
Hmm.
what I mean? So
Right.
why would FICO shouldn't do that? They should give us the same report that you're gonna get, so that way
Right.
everybody's on the same page and there's no kind of like distrust. Because
It,
if
it's
we say our FICO score is like 720, and
mhm.
then you say it's like 690 or 700, we're like, what the hell? I paid all my bills. What's going on? You know what I
It
mean?
ain't gonna be that drastic. It is not gonna be that drastic in terms of difference. But um, again, and as an example, Credit Karma is free, so
Right.
they're
Well,
not
I
gonna
know Credit
do
Karma is not really legit. I mean, they're legit to a certain point, but if you want to
Mhm,
get the real numbers, you got to
mhm.
actually go to the people that are producing it, which is Experian,
Exactly,
TransUnion,
exactly.
or FICO itself.
Okay.
You know what I mean?
Yeah, I've seen where going directly to the bureaus is typically the same when we do the full factual.
Right. Okay.
All right. Yeah.
All right.
Uh, I've seen scenarios where Credit Karma sometimes is the same, and then sometimes it's slightly higher or lower than the full factual.
Right.
Okay. All right. So, but
Okay.
we the lenders, we don't have any control over that. Like you, we get it from the credit bureaus, and whatever they give us, that's what we have to go with.
Right.
Okay. All right. Any other questions? Anybody else have any questions? You can put it in the chat, or you can unmute yourself and ask your question if you have a question. No one have a question.
So also too, you said like other recommendations was is the home inspection. What about I've been seeing a lot of like people actually talking about radon inspections and sewer
Mhm,
inspections, especially if you have a big tree in front of the property because you don't know how deep the roots have gone. That could
mhm.
like damage the sewer line in front of the house, as well
Okay.
as uh what else? Not just roof inspections too, but like water leaks and stuff like that. You know, a lot
Mhm.
of times people have water leaks in their basement, but they try and hide it.
Yeah. So that's when your home inspector come into play. So just like my scenario I shared with you, and
Hmm.
just like what you just said, radon, etc., your home inspector will take care of that. It's a good idea that when you get the home inspector, you want to be there when he at the home and inspecting. So that way you can be there when he produces the report, and you probably could tag along with him and he could talk to you while he's doing his inspection, or you could just wait outside in your car or whatever. And then when he's done, he can go over the report with you and give you the details of the condition of the property and his recommendations in terms of what needs to be taken care of right away and what probably has uh, some enough time where you don't have to worry about it. But it's a good idea if you can. It's not required or necessary, but it's a good idea to be there the day and time the home inspector is there inspecting the property. Right?
Okay, great. Thank you.
You're welcome. Does anyone else have any questions?
Hello? Hello, good evening.
Hey, good evening. How are you?
Good evening. I'm okay. I have a question about, I'm from Hudson County. I have a question about the
Mm-hmm.
HUD housing, the program you have. With that kind of program, would it consist on, like you said, the real estate going to look for the house? Or, like, I done saw a house already and I was interested in it.
Okay.
But I still want a guide, like you guide me through the program and how do it go about. That's why I'm on the line now. I need more basic information about it.
Okay. So what you want to do is the calendar that I put in the chat. Did you see
Yes, I
that in the
saw
chat?
them.
All right,
Yes.
so go to my calendar and pick a date and time to book a 20-minute a one-on-one consultation session with me, and then we can go over your everything in detail what you want to talk about. And if you still looking at that property, we could talk about that. And of course, look at where you are in terms of how close are you ready to buy and get pre-approved, etc.
All
Okay.
right, and I thank you for that. Yes.
All right. And any more questions or is that
No, that was the question I wanted to ask.
okay, great. All righty. Anyone else?
Yes, I have a question. How many people can apply to buy the house?
The same house, you mean?
Yeah, like let's say if siblings want to go on
Hmm.
and
Yes.
buy a house together, how like is
Yeah.
there a
Up
limit
to
to how many
yeah.
people can?
4 people can be on one application to buy the same house.
Four?
Up to four.
Okay,
All
thank
right.
you.
So book your one-on-one session, and if those individuals that you have in mind, if they can join the session, that'd be great. Otherwise, you and I can just do it, the one-on-one session, and you could take the information back to them.
Okay, thank you.
All right. Any more questions? All right, let me check the chat. How do I? Okay, how do I book a one-on-one? Um, you want to go to my calendar. It's in the chat. If you scroll to the top, um, you'll see, you should see my calendar. Uh, it was Gabriel. Did you ask the question, how do I book a one-on-one session? Gabriel, are you still on? And do you see my calendar information?
Yeah, I don't see your calendar information.
Okay.
Yeah, there's no calendar information. I don't see it
Really?
either.
All right, let me open the chat again. Let me close this, open the chat. Uh, okay, do you see it? Gabriel, do you see the information? I just put it in the chat.
Yes, it's there now.
All right, so that link is for my calendar. You
Yeah, I
can
see it. I'm gonna have to try to save it or copy it, though, because when you hang up, it's probably gonna disappear.
exactly. All right, so at the very least, copy my phone number. And if you don't get that, if the calendar information, you can call me, and then I can send it to you. All right. Does anyone else have a question? Let's see. Is Robbie on the line? Okay, I guess Robbie left. Um, okay, Robbie, I'm here. All right. I see you put in the chat. My wife currently owns a house in Buffalo, New York, for her parents. Even though she is the owner of the property, her father always pays the mortgage, and she lives with me in New Jersey. I've never owned a home before in the USA. Now, my question is, if my wife and I want to buy a new house in New Jersey as our primary residence, am I eligible for the first-time home buyers assistance program, since this would be my first home buying? Uh, for the New Jersey down payment assistance program, Robbie, unfortunately, you and your wife won't qualify because her parents own a property. So she wouldn't be the first generation to own. Her parents would be the first generation to own. Now, under our program, where we'll give you 2% of the sales price, if you meet the other requirements, meaning both you and your wife have a 620 credit score, then yes, you can qualify for that one. However, unfortunately, the New Jersey down payment assistance program, uh, you and your wife together won't qualify. Now, if you and your parents do not own a property and you purchase by yourself, then you can qualify. But then that obviously dictate based on your income how much a home you can afford without your wife's income, because we can't count her income if you purchase by yourself. I hope that answered your question. And if not, let me know. Um, Sabina asks about the recording. I guess you came on late. I can see what I can do once it's available and send it to you. Let's see. Oh, Lawrence, I have a screenshot, so I will call you later. Okay, great. My cam and my mic is not in good. Okay, all right. All right, parents. Da, da, da. Okay, great. Okay. Anybody else have any questions? You can ask him now or put it in the chat.
Hi. Quick question. I thought the FHA, if you've never owned a home, you can get it, but you only get up to 15,000. But if your parents bought a home, you won't get the 22. You won't get that extra seven. So I thought FHA you can get if you're a first time home buyer, but you just
Okay.
don't get the 22,000. You just get the 17.
Okay. Sounds like you're mixing the two programs. So under FHA, you can always qualify for their product, FHA loan, as a first-time home buyer if you haven't owned a house in the last 3 years. Okay. Now the New Jersey program that you're talking about, the 22,000, that's a down payment assistance program. Okay. So if under the New Jersey down payment assistance program, you got the fifth, depending on the county that you're looking to purchase in, let's just say the northern counties of New Jersey, then you can qualify for the $15,000 down payment assistance if you meet their requirements, meaning credit score, etc. And if your parents and you don't own a home, when you put the application in, that you can qualify for the additional 7,000, which make it a total of 22,000. So that's separate from FHA. FHA is just a mortgage. New Jersey, $22,000 is the down payment assistance.
Okay. All right. Cool. Thank you so much.
You're welcome. Anybody else? Anybody else have any questions? All righty. Okay, so since there's no more questions, we can go ahead and close out. Again, I want to thank everybody for joining this home buying webinar session. We want to wish you luck in your journey. Make sure you book your one-on-one free consultation session so that we can see where you are in the process and further answer any questions and recommendations for you and help you along the way. If you're ready to move forward right away, definitely book the session so that we can get you started and get you pre-approved and so that you can get out there, start looking for homes. All right. Make sure you have my contact information and you can call me later if you think of a question you did not think of to ask on this webinar session. All right, everyone. Thank you for joining and everybody have a good night and a great weekend.
Thank you. Good night.
You're welcome. Good night.